I said, it doesn't get bigger than DLF when it comes to real estate. Let's get in Mr. Ashok Tyagi, Group CFO of the company. Not just to speak about what's happening with DLF. I mean, there's lots of activity out there, but broadly per se with what's happening in the industry as well, because as we spoke to Mr. KK Mistry earlier, there are signs across the board of some bit of pickup. Mid-income, premium residences, at least some of the smaller names have said that. What is the big boy doing? Ashok Tyagi joins us right now for that. Mr. Tyagi, good to have you. Thanks so much for joining in. Neeraj here, good morning. I just want to maybe rewind the clock a couple of months back, or rather a month ago when you did declare your numbers. And the interesting bit about Q3 to my mind was that there was operating momentum being seen. I mean, I was just looking at some numbers, your launches, your deliveries, and your sales rather per se, at least the launches and the deliveries in Q3 were equal to or more than what you did in the first half of the current fiscal. The question mark really is that momentum likely to continue in Q4 and possibly the next 2 quarters of the next fiscal? Or is it a difficult thing to say at the current point of time?
Okay, Neeraj. So, I mean, obviously, you should never take one quarter out of context in a long cycle business like ours. But to be fair, the reason our first half from a launch standpoint was slightly more muted had of course something to do with the fact that the market itself was muted and the demand was muted, but also because many of our projects were on the final throes of getting their requisite approvals. And honestly, we've begun launching from Q3 onwards once the approvals are in place. So we did I think 3 launches in Q3 towards the end. We've already done 1 launch in Gurgaon earlier part of this week, and you should see 2 or 3 more launches coming across in the next 4 to 6 weeks. So it's like a fortuitous culmination of a lot of approvals being in place. B, obviously, we still believe that despite what the pundits and everybody says, for the right product and the right trustworthy product and the location, there is adequate market, and honestly, I think our launch on Tuesday just proved that. On the execution front, I think we are actually in the process of delivering about 28 million square feet across the next 12 to 15 months, which frankly is unprecedented from an Indian private real estate standard. And really, we are delivering almost 10 million square feet in the next 3 to 4 months. We are delivering 3 odd million square feet in Chennai. And we should have another about 12 million square feet delivery in the rest of Gurgaon coming in about 12 months. So there has been a huge focus on execution, which is the reason also, that earlier we had announced that we are increasingly moving to bigger boys in terms of third-party contractors. And that's what we are doing. So huge focus on execution and select focus on launches depending on what the market is and depending on how our approval situation is.
Okay, then which brings me just to a quick update before we talk about the larger picture again. Since you did mention that the quantum of launches and the quantum of bookings as well is increasing over the next 3 months and the next 12 months, is it safe to assume that the guidance that you'd given at the start, which was 10 million square feet odd for FY12, and please correct me if I'm wrong, even though you've done close to 6.5 to 7 million of square feet for the first 9 months, maybe achieving that 10 million mark will not be a difficult proposition?
I think we've done about 6.8 odd till December.
Right.
And honestly, Neeraj, I don't foresee a great difficulty in hitting somewhere between 9 to 10 million as the final number. Yeah.
Okay.
Right. What's the expectation in terms of the kind of pricing you expect over the next 6 months? And also, how do you propose traction on your margins at this point?
Okay. So as far as pricing is concerned, obviously, I mean, one has to price depending on what the market can absorb. But we honestly believe that, 2 launches. One was the Lucknow launch in December, and one was the launch of the Primus in Gurgaon about a week back. I think in both of those, we priced what we believed was the right and fair price, and the market has has sort of absorbed that demand fairly well. So honestly, at least we haven't been a great subscriber to this entire mega theory that there'll be a huge correction, etc. There's been some micro correction, I'm sure. But the fact is that given the constraint on supply on account of longer approval cycles across the industry, not just for us, across the industry, and B, the fact that, I think that there was some degree of fence sitting on account of both the buyers and the sellers, because of the interest rate regime. There was some degree of slowness in demand, but we do believe that I think we are clearly closer to the recovery cycle beginning than what we were 3 or 6 months back. Now, whether that recovery cycle in full throttle begins 6 months from now or 4 months from now or 7 months from now, honestly, is a decision to a large degree driven by the interest rate movement on one hand, and honestly by the basic degree of growth and other momentums in the economy on the other hand. So I don't see a huge movement in prices across the next 6 months. We see fairly stable pricing for the next 2 quarters.
Okay, the biggest issue, of course, for the company right now is the debt on the books. So what is the debt reduction plan for the company, and what stepwise module or procedure are you following to ensure that debt comes to reasonable levels?
Okay. So, obviously in Q3 we did show a very moderate debt reduction. Our net debt, if you see end of Q3, is somewhere about 22,800 crores, which is high. I want to make no bones of that. We believe that our strong annuity base and the strong rental incomes that we have can clearly support a self-funding debt in the range of 11 to 12,000 crores. So honestly, debt levels up to 12,000 crores are self-liquidating and honestly not worrying. It's the journey from the 22 to the 12 that obviously is the one which one needs to undertake across the medium term. As we have announced for the last few quarters and across the last 2 quarters, one's seen greater momentum. There is a very significant non-core asset monetization plan in place. We have given a guidance and we stick to that guidance of raising between 6,000 to 7,000 crores across the medium term. And when I say medium term, I'm talking of, between 12 to 24 months. So we do expect to raise that kind of money, which should, significantly cut this distance between 22 to 12. And honestly, so once that 5,000 to 6,000 crores, sort of comes into play, then you are dealing with a far more comfortable situation. Also, hopefully, across the next, 2 to 3 quarters, as the economy, industry, and our own operations come back to their full potential, we should again begin generating the kind of operating surpluses which should, further support this debt reduction piece. So clearly, I think this does require some degree of patience, but our strategy and direction is fairly clear.
And which is probably the more critical part, Mr. Tyagi. Speaking to a lot of people across the board, in terms of your non-core asset sale, the bigger chunks for the 6,000 to 6.5 to 7,000 crores, which being Amman Resorts and the NTC Mills, is there an estimated timeline? Sure, 12 to 24 months is a large time frame, but broadly, do you believe that some part of this could happen maybe over the next 9 months itself, or these are long-drawn conversations which will probably take place towards the latter half of the 24-month cycle that you mentioned? And for starters, you'll probably do away with maybe the wind assets or the land parcels in Chennai, Jalandhar or Dwarka for that matter.
Okay, so Neeraj, clearly in Q3, we did at least one major transaction, which was the Pune IT SEZ. We also did a small transaction of the Noida IT Park. Both Amman and the other assets you mentioned, all of those are assets on which one is having conversations. Clearly because of the macro liquidity issue, to some degree, I think there has been, these things will take time. Honestly, whether they'll close in 4 months or, frankly, 8 months would be very speculative for me to comment on. But we do, we are sort of looking for at least, in terms of closure of these market transactions across the next fiscal at least.
And so my simple question really was trying to find out if indeed these news reports which speak about you being in conversation with China's HNA Group and a couple of other marquee names for Amman at least, are these indeed true? Are you close to fructifying something, if at all?
I'm not going to divulge bilateral conversations with anybody on national television, Neeraj. I'm sorry.
Okay, I mean, you can't blame me for trying out my luck at least. Okay, the other part, Mr. Tyagi.
No, I'm sure. So
the other part, Mr.
Well.
Tyagi, is how is the leasing business shaping up for the company? Because the last time, I mean, this is of course a couple of years ago when we visited your properties, it seemed to be fairly okay. How is it shaping up now for the entire leasing portfolio for DLF?
Okay, so leasing business, in all fairness, I'll tell you, the 9-10 was the weak year because that was the year, when we were coming off the entire global crisis. 10-11 was actually very good. We did, I think, in excess of almost 5 million square feet of leasing. This year we began well, but the leasing quantum cumulatively done so far, the gross leasing is about 2 million square feet. We have seen some slowness in commercial leasing in the last 2 quarters. Again, I think linked to the macro piece. I expect that it will take a couple of quarters for this to bounce back fully, but this is a business which we have now seen through the worst crisis and the best of times is an extremely strong and stable business. And we hope that, we expect that this should continue. There might be occasional quarter when the leasing quantum is lower than what one expected it to be, which has been the case in the last 2 quarters. But I think as the global situation stabilizes, this should come back. The FDI in single brand should help to some degree. The FDI in multi-brand, as and when it happens, would obviously help to a bigger degree. So honestly, I think the leasing business per se remains one of our strongest pieces of operation. We have in excess of 20 million square feet of spaces under leasing.
What about the NCR region? Your recent property there has drawn some interest. Do you see things stabilizing there?
Which one? I'm sorry, I missed that.
The NCR region, essentially. Do you see things stabilizing for that region? Because prices have been on the way down.
We do expect some degree of stabilization to come on that aspect as well, yeah.
One final question really before we ask you if indeed you have any wish list from the budget as well, Mr. Tyagi, is that you did mention about the quantum of deliveries that we'll do over the next 6 to 9 months or 12 months. That aside, a couple of strategies that you've done wherein you're selling plot sales, you're pushing plot sales at a great degree over the last 6 months, and that I believe is gaining some momentum as well. One, is the reading true? And 2, is that expected to continue over the next 6 to 9 months?
Okay, so the reason we went into plotted sales pretty aggressively across the last 12 months, almost after I'd say 15 odd years, was driven by 2 things. One was that it was our read which proved to be correct, that even in the most muted market sentiment, the plots at the right price was a product which the market always absorbed. It happened in Chandigarh, it's done well in Gurgaon, it's done well in Lucknow, it's done well in Hyderabad. So across the country we had success with that product segment. B, the inflation in the last 2 years has really resulted in a great degree of I'd say tentativeness on the degree of inflation that one sees in the construction costs. So plots is an inflation neutral product. There isn't too much of development expense. And lastly, the cash flow cycle is just far faster than in a normal high rise. But as the markets begin to improve, you would clearly see us doing a mix of the classical high rise premium and super premium and luxury segments and plotted. But plotted developments will continue for sure.
Okay, one final word then, Mr. Tyagi. You're sitting next to Pranab Mukherjee. He's asking you your one top wish list from the budget, which he can pull out of the briefcase. What would it be?
I'd say if there was one thing that I could pull out of the briefcase, it is that I think the home buyer should be given substantially more encouragement to invest in housing than what's the case so far.
Okay, I'm sure a lot of other people would have probably asked for industry status or a couple of other wishes, but it's good as any, Mr. Tyagi, to have you and give us a perspective of DLF, the industry, and the budget as well. Great having you. Thanks so much for taking the time out and joining us. Well, that's the view from the big boy. Things seem okay. Deliveries on track. They're sticking to the guidance of what they would do in terms of debt reduction, as well as non-core asset sales over the next 12 to 24 months. Of course, not willing to divulge any kind of details. but things seem to be picking up in launches as well as in terms of deliveries. And fourth quarter, the other important thing that they did say that they do not foresee any problems in meeting that 10 million square feet guidance. I mean, 9 to 10 is what he said. So average it out, would probably be able to meet the earlier stated guidance.